Welcome to the deep dive. You've sent us a stack of sources that place us squarely in the first full week of December 2025.
Right.
And it feels like a moment when the entire global market is just holding its collective breath, waiting on a critical U.S. Federal Reserve decision.
It really is. And our mission today is to cut through that noise.
Yeah.
We need to analyze the high-stakes strategies and macroeconomic drivers that are, frankly, pulling markets in three different directions right now.
And that's what's so fascinating. This isn't a simple story.
Not at all. This deep dive is necessary because what we are seeing across assets is, well, it's profoundly contradictory.
How so?
Equities are soaring. They're driven by projected policy easing. But then you look at fixed income, specifically long-term bonds, and commodities.
Real world stuff.
Exactly, the real-world gauges of demand. And they were screaming signals of deep skepticism. We're in a phase of what you could call anticipatory positioning.
Okay, so the market is almost certain the U.S. is cutting rates?
Absolutely certain. But that certainty is actually breeding a lot of confusion about the future.
So optimism is colliding head-on with skepticism. Our goal today is to unpack those three main conflicts for you. Why is the market so optimistic right now, but so doubtful about the long term?
A great place to start is the U.S. policy paradox.
Certain easing, uncertain future.
When we look at the case for immediate easing, the evidence is pretty compelling. The main thing driving all this optimism is that the threat of inflation seems to be receding.
And the key data point for that is the core PCE, right?
Yeah, that's the one. It stands for personal consumption expenditures. It's the Fed's favorite measure because it captures how people actually shift their spending patterns.
And what did that measure tell us back in September?
It came in at 2.8% year over year. That reading was a huge relief, honestly. It was well below what a lot of people had feared.
So it shows inflation is cooling off.
It's decelerating toward the Fed's long-term target of 2%. And on top of that, recent labor market data, especially from private sector payrolls, points to a kind of gradual cooling in hiring.
So you have those two things together, disinflation and cooling jobs, and that makes the case for a rate cut.
It makes the case much, much stronger.
And the market completely believes it.
Oh, absolutely. The market is pricing in a near certainty. We're talking odds around 87% that the Federal Reserve will trim the target range for the Fed funds rate.
By 25 basis points.
By 25 basis points, or BPS, which is just a fancy way of saying a quarter of a percentage point. This would move the target range to 3.50, 3.75% this Wednesday, December 10th.
It's seen as a done deal.
A total certainty.
Okay, this is where the contradiction hits, and it's the most confusing point for me in all the data.
I think for a lot of people.
If the Fed is about to cut short-term rates because the economy is cooling, why is the benchmark 10-year U.S. Treasury yield climbing? It just settled at 4.15%. That feels backward.
It feels completely counterintuitive. And that behavior is a huge structural signal of market skepticism.
Okay, unpack that.
The 10-year yield reflects the market's long-term view of inflation and growth. When it climbs while short-term rates are set to fall, it suggests investors are demanding a significantly higher long-term inflation risk premium.
What does that actually mean for us, though, in simple terms?
It means the market fundamentally doubts the Fed's ability to keep prices stable over the next decade.
So they think the Fed is making a mistake.
They're worried the Fed might be cutting rates prematurely this week. They fear the long-term consequence could be inflation coming back in, say, 2026 or 2027.
And to protect themselves from that risk, they want a higher return on long-term bonds.
Exactly. They demand a higher yield for holding those long-duration bonds, and that's what pushes the 10-year rate up to 4.15%.
So this 4.15% number isn't just a data point. It's an active threat to the markets we all care about.
Precisely. For you, the investor, this rising yield is a foundational stress test for valuations. It raises the risk-free rate that everyone uses to discount future earnings.
So a growth stock's future profits are suddenly worth less today.
Dramatically less. When you discount profits that might not show up for 5, 10, or 15 years at a higher rate, the present value of that stock just drops. It's a huge structural headwind for those high-flying growth stocks.
And digging into that bond market, we're even seeing a split within fixed income itself.
We are. It's a real bifurcation. On one side, broader bond indexes like the U.S. Core Bond Index are declining.
Because they hold those long-term treasuries.
Right, which are getting hit by the inflation skepticism. But then on the other side, the U.S. High Yield Bond Index is actually rising.
Wait, so the riskiest corporate debt is going up. Isn't that just optimism based on short-term cheap money?
That's a very sharp observation.
It seems like that part of the market has blinders on to the 4.15% long-term risk.
It kind of does. The high-yield segment is really only focused on the immediate prospect of cheap borrowing. Lower short-term rates ease financing costs for indebted companies, so it reduces the risk of default right now.
So one market is cheering and the other is screaming a warning.
That's it in a nutshell. It's a very complicated message.
And this all connects back to the Fed itself. The certainty of this one cut masks massive uncertainty about 2026 and beyond.
Absolutely. The sources highlighted a highly unusual degree of division within the FOMC, that's the Federal Open Market Committee, about the future path of rates.
And we see that in the dot plot.
Exactly. So for anyone who doesn't know, the dot plot is just a chart where each FOMC member puts a dot where they think the Fed funds rate should be in the future. The current median dot plot implies only one cut for 2026 and one for 2027.
Which is a very slow, cautious pace.
Very cautious, but the risk is that they might choose to front-load those cuts.
Why would they do that?
Well, if they think this gradual cooling in hiring is about to become, widespread corporate firing or real slump, they would probably shift that 2026 median down closer to 3.0% to get ahead of it. And that internal debate over the pace is what's feeding so much anxiety.
Okay, so that brings us to our second major contradiction. Equity ambition versus real demand signals. The bond market is skeptical. How does that skepticism translate to the stock market, where targets are, frankly, astronomical?
The equity strategists are riding high on this promise of Fed easing. The S&P 500 closed near its all-time high of 6-day 890.9.
And it's only about 3.5% away from the year-end target of 7 to 100.
Right, but the real story is their 2026 projection.
Let's talk about the $8,100 target. That just sounds lofty.
It is extremely ambitious. An $8,100 target for the S&P 500 relies on two key things happening. First, projected 12% earnings growth, which gets you to about $305 in earnings per share, or EPS.
Okay.
Second, this is the crucial part, it requires sustaining a forward price-to-earnings multiple of 26.5x. 26.5 times earnings. That's high by historical standards, especially with the 10-year yield over 4%.
Exactly. Even analysts are calling that multiple lofty. You basically need perfect execution on earnings, no major shocks, and low inflation for that PE to hold up.
And if that 4.15% yield we talked about stays up there or goes higher?
Then that 26.5x multiple simply must compress. It has to. And that would undermine the entire case for an $8,100 target.
To be fair, though, Q3 corporate earnings gave them some reason for that optimism, right?
Oh, they absolutely did. With nearly all companies reporting, earnings were up an impressive 12.9% on 8.2% revenue growth. That blew past the estimates.
And it was broad-based.
Very. 10 of the 11 S&P 500 sectors showed positive earnings growth. This resilience is why strategists still favor cyclical sectors, tech, communications, industrials, financials, the parts of the market that do well when the economy expands.
Okay, so we've got strong earnings, record high equity targets. If corporate America is so healthy, why are commodities, the very fuel of the global economy, flashing red?
This is the clearest conflict. This is where the physical economy really casts doubt on the financial projection.
Right.
WTI crude oil futures, they fell sharply. More than 2% to trade below $59 a barrel. That's near monthly lows.
And crude oil is just a really sensitive barometer of global economic health.
Incredibly sensitive. A sharp slump like this is almost always driven by signs of softer fuel demand.
So a drop below $60 a barrel suggests global economic activity is slowing down faster than the stock market is admitting. Is that fair?
That's a great way to put it. It indicates the need for transport and industrial consumption is weaker than people thought. And it's not just demand. You have supply pressure, too. The latest DIA report showed U.S. crude inventories unexpectedly rose.
More supply, less demand.
Equals a collapsing price, which just doesn't square with the narrative of a robust cyclical expansion that would justify that 26.5x PE multiple.
And what about gold? I mean, it's supposed to be a safe haven when there's uncertainty, but it seems to be struggling.
Gold is caught in a tough spot. While it is technically in a bullish long-term trend, that rising 4.15% 10-year Treasury yield increases the opportunity cost of holding it.
Because gold doesn't pay you anything.
It pays no interest. So when you can get a 4.15% risk-free return on a bond, holding gold becomes comparatively more expensive. It makes its short-term outlook questionable until that bond yield comes down.
That's a perfect example of how the bond market skepticism we started with directly undermines commodities. Okay, let's move to our third and final contradiction, global policy divergence and FX volatility.
And this one is a big one.
Yeah, especially the dramatic split between the U.S. and Japan.
While the U.S. is easing, The Bank of Japan, the BOJ, is signaling potential tightening.
Yeah.
There's growing speculation of a rate hike as soon as next week.
That's a monumental shift for them.
After decades of ultra-loose policy, yes, it's huge.
So what's driving this turn in Japan?
It's a mix of political will and monetary necessity. The yen has strengthened recently, and it's being supported by some genuinely hawkish policymakers. The government also has a clear desire to support a stronger yen to fight import costs.
Because a stronger yen makes imports cheaper.
Right, which eases the cost pressure on consumers who have been getting hammered by inflation.
But the domestic picture in Japan makes this rate hike a really dangerous gamble.
It really does. I mean, the timing is a huge question. Recent data shows their Q3 economic growth actually contracted more sharply than first reported, and real wages have fallen for the 10th straight month.
So they'd be tightening into a slowing economy where people are already losing purchasing power.
It's a huge risk. They could choke off any chance of a sustained recovery before it even starts.
And this clash between U.S. easing and BOJ tightening creates a huge systemic risk, doesn't it? Let's talk about the yen carry trade unwinding.
This is arguably the most difficult to hedge volatility risk in global capital flows right now.
Explain what that is.
Okay, so think of the global financial system like a giant Jenga tower. For years, investors have relied on one of the bottom blocks, the cheap Japanese yen, to borrow money cheaply.
And then they invest that cash elsewhere for a higher return.
Exactly, in U.S. stocks, emerging market bonds, you name it. That's the yen carry trade.
And what happens if the BOJ pulls that block out of the tower?
Well, if the dollar weakens because the Fed cuts and the yen strengthens because the BOJ hikes, the whole thing could unravel very quickly.
So investors have to pay back their yen loans with much more expensive yen.
Right, which forces them to sell off their other assets globally to raise cash. It could trigger a rapid cascading sell-off in markets far, far outside of Asia.
Meanwhile, we've heard almost nothing from the Eurozone. They seem to be taking a steady hand approach.
That's the perfect description. The ECB is not focused on immediate pivots. An executive board member, Isabel Schnabel, she noted that services inflation is stickier than expected, which suggests rates are likely to remain steady for some time.
They're focused on durability, not reaction.
Exactly. And their long-term focus is firmly on infrastructure. Another board member, Piero Cipollone, just gave a speech about leading the digital transformation of money, basically building out the architecture for the digital euro.
They're playing the long game.
Deep, long-term technological stability over short-term tweaks.
So, after all that, what does this all mean for you? We've seen the market pull between two fundamentally different worlds.
Yeah. You have asset valuations that are aggressively optimistic because of cheap short-term money.
And then you have tangible, real-world skepticism driven by rising long-term yields and weak demand signals, like that crude oil slump.
We've covered three massive contradictions, but I think there are two critical risk takeaways you should monitor closely.
Okay.
First, that aggressive 2026 S&P 500 target of $8,100. It relies so heavily on sustaining that historically high 26.5x PE multiple. The fact that the 4.15% long-term yield is so resilient is a direct structural threat.
If that yield keeps climbing, the multiple has to fall.
It will compress, creating a major headwind for stocks. Second, the divergence between the U.S. easing and the BOJ tightening is creating immense, difficult-to-hedge volatility risk from the yen carry trade. This isn't just a currency problem. That reversal could rapidly destabilize global markets.
And here is the final provocative thought for you to think about as you dig into the source material. The core economic data that justified the Fed cut, that inflation deceleration, was specifically linked to flat real consumer spending. We also know lower-income households are struggling to trade down to cheaper goods. So if corporate profits are beating expectations and projecting $305 EPS, but the real economy shows flat consumption and a collapsing crude oil price, how long can the market ignore the fragility of the broader consumer base before it inevitably jeopardizes those lofty earnings projections?
That is the multi-trillion-dollar question.
Keep digging into those contradictions, and we'll see you on the next deep dive.